We do want to get back to the markets today because stocks and Treasury yields rose today on speculation that the Federal Reserve is preparing yet another round of stimulus. Fed Chairman Ben Bernanke is set to speak in Jackson Hole, Wyoming on Friday. Last year, you might recall, he announced the Fed's second round of quantitative easing at that same conference. Well, joining us right now from Boston is David Rolley. He's co-head of global fixed income at Loomis Sayles, where he manages its $2 billion global bond fund. That fund, by the way, has beaten 84% of its peers over the past year. So it's a good performer. David, good to have you with us. We're all speculating about what we might get on Friday out of Ben Bernanke at Jackson Hole. The markets seem to think there's more quantitative easing. Do you think that's indeed going to happen?
Well, it's a good question. Right now, if you look at U.S. 10-year Treasury yields at 2.1%, down from 3% only a month ago, you'd have to say that the Treasury market is priced probably for a lost decade of very disappointing growth and stagnant living standards. So with that as what's in the market now, at some point you might expect the Federal Reserve to step up with QE3. But the data in July was just strong enough that you may not get the speech that some traders are expecting on Friday. The Fed may still hold off, hoping that the economy picks up a little bit of steam on its own.
You say that the market is not pricing in QE3 right now, so you're not looking for...
That is correct.
What I was thinking is if there's a disappointment, because a lot of people talk about it, even though people say it's low probability, it seems to be still the prayer that's holding this market up. So if we don't get it on Friday, do we see bonds tank, or what happens?
I think a lot of people will take almost any excuse on Friday to take profits. So if we do not get something that looks like QE3, I think you will see profit taking in the market.
So you think there will be a sell-off in Treasuries then, and we'll see yields then finally go back up?
What's interesting is it might not matter what the chairman says, because if you do get QE3, you may get a sell-off because people would feel better about risk appetite and be moving their money out of bonds to stocks. Than if you don't get a speech, if people have profits to take, they'll just use it as an excuse. So I think the market's vulnerable on Friday.
Hey, David, let me ask you something, because in June you didn't own any U.S. Treasuries, and your Vice Chair Dan Fuss actually said you were happy about that. I mean, we've been talking a lot here on Bloomberg about how Treasuries have been outperforming. Do you regret that call?
Well, if I were clairvoyant, I probably would be working for a company that had my own name on it. We didn't feel like the value proposition was particularly compelling at that time, and right now we feel that the value proposition is worse. We see Treasuries as very rich here.
All right, so
we don't think we're going to have a lost decade. If the Fed has to, it will go to QE3. But it would be better if that ship doesn't sail alone. What we need is a fleet action, and we need the Europeans and the Japanese to sail with us.
Yeah, we're keeping our fingers crossed on that one. Hey, David, just got a few seconds left here. So where are you investing along the Treasury curve at this point, or are you staying away?
Right now, we're about 6 months short of our duration, but we own a lot of high-quality corporates, and we own a lot of other currencies. Remember, it's a global bond fund, and 60% of it is in non-dollar positions.
All right, we're going to leave it there. David Rolley of Loomis Sayles and Company is the co-head of Global Fixed Income. David, thank you so much.